Hello guys, welcome to i-tutor Academy. In today's session, we will start with the Unit 5, Subsession 4 of Banking Structure in India. Okay, it's an MMPC-003, Unit 5. And in last video, we discussed the financial system of India, the same unit. And as discussed previously, banks are one of the most important segment of the money market. Let us read about the banks, their functions, the structure of the banking system in India with special reference to RBI. Definition of bank according to the Banking Regulation Act 1949. A banking company is a company that tracks the business of banking in India, and banking means accepting deposit of money from the public for the purpose of lending or investment, however with the promise of repayment of the demand by the depositor with the facility of withdrawal by check, draft, order or otherwise. The functions of banks have changed from traditional, that is accepting deposit and the lending credit, to many more functions like collection and payment of checks, bills and promissory notes, sales and purchase of securities, remittance of funds, merchant banking services of automated teller machines, that is ATM, electronic fund transfer system dealing in foreign exchange and others. So here is one figure, banking structure in India. There is RBI is the main head of the banks. Then there is a scheduled banks in India, and scheduled banks in India divided into two, that is scheduled commercial banks and scheduled cooperative banks. And scheduled commercial banks again divided into four. There is public sector bank, private sector banks, foreign banks and regional rural banks. And public sector banks are nationalized banks are there, State Bank of India and its associates are there. And the private sector banks, that is old private sector banks and new private sector banks are there. So this is a basic division of banking structure in India. The structure of banking in India presented in figure 5.3 we already discussed, and at the helm of the affairs there is RBI, which is regulator of the banking sector and supervise the monetary policy of country. After that we have scheduled bank that are further classified as scheduled commercial banks and scheduled cooperative banks. Public sector banks, private sector banks, foreign banks and regional rural banks, that is RRBs. Within the public sector there are nationalized banks and State Bank of India and its associates. Private sector's bank have two categories, old and new private sector banks. Okay, in the following section you will briefly read about them. There is Reserve Bank of India, the head of the banks. RBI is an apex bank of the country and act as a regulator of the financial and monetary system in the country. And functions of RBI is here. Some of the major functions: note issuing authority, banker to the banks, banker of the government and debt manager, banking sector regulator, foreign exchange manager, maintaining financial stability, development role, regulator of the monetary policy. And note issuing authority, RBI has a monopoly over note issuing in India other than 1 rupee notes or coins and coins of smaller denomination, and RBI ensures that both currency notes and coins are available in an adequate amount in the country. And a banker to the banks. All the banks in the country have an account in the RBI via which bank settle interbank transaction and customer transactions. Next is banker of the government and debt manager. RBI act banker to the central government of the country along with those state governments which have agreed with the RBI. It maintains the government accounts and this financial transaction from this account along with the transfer of government funds. And next is banking sector regulator. RBI regulates and supervises the banking system of the country in accordance with the various provisions of the RBI Act and Banking Regulation Act. RBI as a regulator does a wide range of activities like providing licenses, prescribing capital requirement like capital adequacy norms, paid up capital and lending to the priority sector of the economy like farmer, women, etc. Next is foreign exchange manager. As you may have read, the trade is very essential for any economy. For conducting trade, adequate stock of foreign exchange reserve are an important requirement. RBI plays an important role in both the development and regulation of the foreign exchange market. It regulates the transaction which are related to both exports and imports and ensures smooth conduct in the domestic foreign exchange market. Next is development role. RBI aims at promoting financial literacy and education among the public and also ensures that credit is available to the productive sector of the economy. For the development purpose, RBI has established many institutions like the National Bank for Reconstruction and Rural Development, that is NABARD. Unit Trust of India, Deposit Insurance and Credit Guarantee Corporation, Industrial Development Bank of India, that is IDBI, among others. Next is regulator of monetary policy. Monetary policy is the policy of RBI through which it regulates the financial market of the country, and most importantly, it is used for credit control. Credit creation is one of the chief function of the bank. Okay. Next is quantitative method is there. Quantitative method are used to control total quantity or volume and the cost of the credit created by the banks. Cash reserve ratio CRR, it is the minimum amount that bank keeps with RBI as a corporate proportion of their net demand and time liabilities, that is NDTL. The CRR percentage is notified from time to time by RBI. And statutory liquidity ratio SLR is there. It is the percentage of NDTL that bank have to mandatory maintain in safe and liquid asset like cash, gold or government securities. SLR restricts the expansion of bank credit, increases banks' participation in the security markets, especially government securities, and it also ensures the solvency of banks. Next is refinance facility. This facility used by RBI to provide adequate credit to the selective sectors like the export sector. And bank rate policy, and according to RBI Act 1934, a bank rate is the standard rate at which RBI is prepared to buy or rediscount bills of exchange or other commercial paper eligible for purchase under this Act. Repo rate, it is the rate at which RBI lent to the bank overnight against the collateral of government and other approved securities under the arrangements of liquidity adjustment facility. Reverse repo rate, it is a fixed interest rate at which RBI borrows from the bank in order to absorb liquidity for the short term, that is overnight basis. And liquidity adjustment facility is there. The facility was introduced by RBI after it was suggested by the Narasimhan Committee on Banking Sector Reform of 1998. It is a mechanism for managing the liquidity needs of the bank. It aims to inject or absorb the liquidity from the system in the situation of shortage and excess. Okay, and policy rate, as this is on April 2021, like that it will update year by. So you just follow up that. Okay, and open market operations, it refers to buying and selling of government securities by RBI in the money market. Market stabilization scheme is there. In 2004, the scheme of RBI was launched in order to withdraw excess liquidity from the market by selling government bonds. Okay, and the marginal standing facilities, it is a facility for banks that can be used in an emergency. Under this facility, scheduled commercial bank can borrow up 1% of their NDTL at 100 basis point more than the repo rate for the short term from RBI. And inflation, deflation and quantitative method as there. Let us take an illustration to demonstrate how RBI uses these methods in the time of inflation or deflation. Okay, so there is an example, you just go through your material. And qualitative methods or selective methods, these methods focus on certain sectors only. By using these methods, RBI can divert the flow of credit from one sector to another. The different qualitative methods used by RBI are credit rationing, consumer credit regulation, increasing margin requirement, moral suasion and direct action and others. And the next is credit rationing. Under this method, RBI controls and regulates the purpose for which credit is granted by banks. The central bank can put a ceiling on amount of loans that can be advanced to bank. And the next is consumer credit regulation. This method help in controlling excess spending by the consumers. RBI can direct bank to fix a minimum percentage of down payment, installment amount, loan duration, etc. Margin requirement. Margin requirement is the difference between the market value of the security which is pledged for taking a loan and the maximum amount of loan which can be disbursed against this security. And there is an example also. Next is moral suasion. RBI requests or pursues commercial bank to behave in particular manner according to the financial situation of the economy. For example, during inflation, RBI requests commercial banks to restrict bank advances. And next is direct action. It refers to the direct action and controls which RBI enforces on particular or all banks in case of default or no adherence to advice of RBI. RBI can reject the request of banks for grants or rediscounting facilities, or it may levy penal rate interest on loans that banks borrow beyond the prescribed limit. Okay, so this is about today's session. If you have any doubt, you can comment it on our comment box, or you can contact our contact number also. Thank you so much.
i-tutor ES presents Ignou MBA, complete syllabus coverage classes and individual semester base, subject coverage program for MBA students online and flexible sessions. For more details, contact 62382 17885.